Hi everyone, I'm Russell Muldoon from Montgomery Investment Management and welcome to this week's video insight. Well, for today, with company filing now largely completed, we're going to talk briefly about an issue that we see in this year's reporting season that really stood out to us on top of some of the positive themes that continue to develop for some high quality industrial, healthcare, telco, software as a service type businesses, and indeed those leveraged to a falling Australian dollar. What we have again noticed this year is not only a continued effort by businesses in cutting costs, but because they've been doing this since the GFC, they are already running very, very lean, and therefore cost cutting to drive earnings growth is becoming harder and harder to achieve. After years and years of proving to be a fertile strategy for management, this time around, we believe it's one of the main drivers behind earnings growth slowing this year for the Australian stock market in general to just 5 to 8% excluding resources, which is an underwhelming result in our opinion. An issue that immediately springs to mind is that in future periods, because recent cost-cutting initiatives have come largely at the expense of investing back into the business today, one simple truth is that if you don't invest today in more productive assets, then eventually there will come a time where revenue and therefore earnings growth will likely disappoint investors even further in the future. We note with interest that for the Australian stock market, if we look at consensus analysts' expectations, they currently forecast earnings growth of just 3 to 5% in 2016. Again, this is well below recent past. And if this holds true, potentially explains the sheer number of companies we've seen this year who have provided very vague or no forward-looking outlook statements. This is a trend that not only speaks volumes of management teams being low on confidence in achieving a decent return on capital in the current economic climate, but is also symptomatic of a market being driven by low interest rates and an appetite for, or investors' appetite for dividends. Sure, high dividends are great for the self-managed super fund army right now, but what benefit are those dollars when essentially they just end up in a low interest bearing term deposit or residential housing instead of productive expansion opportunities which create employment for the economy? Now clearly it's hard to get optimistic about the Australian economy if one just focuses on the end of the resource boom, capex investment falling, and the housing cycle that's quite possibly closer to its peak than the bottom based on APRA's recent movements. There are, however, a few bright spots in the economy and therefore in the Australian stock market. Now, our job at Montgomery is really simple. It's to focus on the positive tailwinds, those which are likely to drive a business forward over time, and position our portfolios correctly to take advantage of those themes. And some of those we mentioned at the start of this video, we think are most certainly worth considering for your own portfolio. Now, one thing we'd like to see going forward, however, is more companies doing the same thing, and that is focusing on the positive things within their business and thus ramping up investment plans and delivering on their potential growth story rather than focusing on stripping the business today to pay higher dividends at the expense of earnings growth and future shareholder returns. Now, that's something we really would like to see, and unfortunately we don't see it yet. Well, that's all for me this week. Please remember to follow us on Facebook and Twitter. Keep an eye out daily for insights by the entire team here at Montgomery, and I look forward to seeing you next time.